Wow. Wasn't last week just a crazy ending? We had a short week because of July 4th. Then we had ADP report come out at 497, 100% beat. Then we had the BLS report come in at 209, a significant miss to the downside, and a correction of 100,000 from previous reports. And we have the CPI report, which now I understand is expected to be 3.1. I'm actually calling out 2.9. I'm standing out on a very, shaky branch. But Dan, what is going on? What happened in the market with jobs, ADP on Thursday, BLS on Friday, and then how are we set up for inflation on Wednesday? Wild times ahead.
Yeah, I think actually it was a roller coaster ride, first of all.
Yeah.
And that's because of the results of those two reports for the most part.
We're very different.
So as you said, ADP, here's last week's calendar. ADP came in way higher, 497 versus 228. And non-farm payrolls, it didn't come in a lot lower. I would say it's basically even.
Well, the one important point there was it's the first time actuals were below expectations in 11 months.
Yeah, but
yeah, it's fine.
Expectations, how do they figure those out? And why were they so far above them last time?
Good question.
Look, that last month they were expecting 200 and they got 306.
Yep.
So this month they're expecting 225 and got 209. I'd say they're finally getting it right for a change.
Okay.
And then the unemployment rate, which is an important one to watch, as I've talked about before, it's one of the things that I watch for coming recession. I want to see that spike by a half a point or more,
right. And it went down
before the recession will start. And we actually went down. So ADP is what sent the market lower on Thursday. The non-farm payrolls is what sent the market higher in the beginning, in the morning.
Yep.
And then I think because it was a Friday and because of the uncertainty about next week's CPI, I think it sold off. And there's some other reasons too. I'll show you the chart, and there's some things to be concerned about right now, actually.
Yeah. Well, let's get into that, but let's set up next week. CPI Wednesday is a big day. That's the last inflation reading. That's the last big number before the Fed meets at the end of the month.
Right. And this one does not show the forecast, but you said 3.1 is what they're
3.1,
saying.
correct. Yes, 3.1.
So 3.1, I think it's going to be 3. You think it's going to be 2.9.
Yep.
So we'll see. But speaking of that, let's go look at the CPI. So this was in my newsletter this week. This is my go-to CPI chart. And this shaded box up here illustrates the 12-month base effect.
Yep.
Basically, every month that a new number is reported, previous month drops off. So you can see last month when we went from 4.9 to 4. So keep that in mind. That's a 0.9% drop. And a lot of it was because of this. Look at the big, huge one that dropped off last month, right? Well, the one that drops off next week is even bigger.
It is.
So remember, they're forecasting another 0.9, just like we had last month, but there's actually a bigger one that's going to drop off. So that's why 2.9 may not be unreasonable.
Yeah, and again, it's really about the month-on-month number. Month-on-month numbers for headline, they're expecting 0.3. Last month, we got 0.1. If a headline comes in at 0.1, we will get a 2.9. That's just how math works.
Yeah, and it kind of works. That's kind of illustrated down here. So it's the rate of change of these numbers. And you can see that even if it was even if it came in equal to last month, the rate of change would still be down.
Yes.
So it would still push it down. So yes, even at 0.1, it's still going to push this down from that. And core CPI dropped slightly last month.
Yeah, and
Now,
core CPI, just so you know, is expected to be 5 next month.
Yeah.
I'm calling 4.9. And again, the thing I want people to remember about core is core doesn't get really better till August.
Right.
August is when the housing, aka shelter data, starts to roll over.
Yeah, interestingly, where's that CPI? Right here. Yeah, right above. Interestingly, in August, we actually are not dropping off a positive number. We're dropping off a negative number.
Yeah, for headline.
For headline. So it's going to be really interesting to see how those two things butt heads.
Yeah, it's funny you bring this up. I'm glad we're going here. I actually think, again, I'm out on a very shaky branch calling 2.9 for July reading. I'm actually calling 3 for the August reading because of the base effect. I think inflation might break trend.
It'll go back up. I think it might go up more than that. I think it might go up to 3.2 even.
Yeah, so it's going to go up. Exactly.
And what will happen is that, people that don't understand this, the base effect, like the media.
Yeah, they just lose their mind.
The media will say, "Oh my God, the Fed was right." I don't think the Fed's going to raise on the 26th.
Well, let's talk about that because you and I are now on a very small island, or at least it's a big island with very few inhabitants. The current smart money on Wall Street, 95% people think they're raising.
Right.
And you and I are like the only two guys left that are saying they're not going to raise.
Yeah, here's the rate hike on the 26th right here.
Yeah.
So I don't think they will. And the reason is because of the CPI number that's going to come in, especially if it comes in at 2.9. But if it comes in below that 3.1, which I think it will, then the Fed is going to say, look, the stuff, we still have some concerns. The jobs numbers were weak, but we'd like to see it even weaker.
Right.
So I think they probably won't raise.
Yeah.
Now, however, we're right here right now. However, they will say we reserve the right to raise and we still think we need 2 more by the end of the year.
Of course, that's going to be his talk track this whole time. He has to talk tough. He can't tell the market he's done.
Right. I think they will continue to say that. And they will have reinforcement in August.
Oh, they will. Absolutely.
And in fact,
there is no Fed meeting. There's no Fed meeting.
There's no Fed meeting. There's not a meeting until September.
Right.
So I think they will probably raise in September.
Oh, okay.
And then I don't think they'll raise again after that.
So you've got one more rate increase. Okay.
I think there might be one more. Yeah. I think they're itching to do one more.
Yeah. Okay.
And I think the August number, that's why I say it's going to be interesting to see what the housing number, how it affects the CPI number. Because the two of those things are going to be butting into each other. It may, the headline may actually go up while core actually might be static or go down.
Exactly. I think I've told people that inflation has 3 variables and core is not going to really see meaningful fall until housing. And that starts in August. And by that point, I think headline's done, falling. So again, I think headline will get sticky, at sub 3, and then core will start rolling over. That's just how this is going to play.
Yeah.
out.
So if you look at the rest of these after July, after August, this is the July number, but reported in August.
Correct. It reported in August.
So after that, it's still going up, but the next 2 are not going up very much. So even if we get a number of 3.2, let's say, then it's going to probably be really slow coming back down.
This is when it gets hard.
3.2, 3.30, 3.1. It'll still be above 3 probably.
This is when it gets hard. This is when it gets hard.
Yeah, that's why I think the Fed will say, well, we're going to hike one more time in September.
Okay.
And then when we get to this one, it'll look like it's dropping again. So this is the October, this is November, so this will be December, the December number, whereas it got a bigger one. So December, I think, is going to probably be in the 2 somewhere. And then we'll have another one that's really small, and then we'll have another big one. So I think we're going to probably be at 2.5 by the beginning of next year, 2.5 to 2.7, something in that range.
Yeah. So let's split. Let's call it 2.6. I mean, if the Fed's at 2.6 come January 2024, I think that's a win, especially if unemployment's below 4%. If we have 2.6% headline inflation and an unemployment rate below 4, hey, the Fed's done it. I mean, at that point.
Yes, and hopefully they will see that they've done it. Now, I want to caution everybody, because this seems like it sounds really good. Wow, we're going to get a number of 2.9. Mm-hmm. Inflation is dropping off a cliff. But keep in mind that this is the inflation rate.
Correct.
So June of last year, here's the peak right here, was at 9%. All right. Mm-hmm. So even though the rate of change for inflation has been dropping, everything that went up by 9% here in June is still at 8 or 9% above what it was a year before.
Yep.
So yeah, the rate of change is dropping, but the cost of goods is still up there.
Correct.
And the only way to bring that down is negative inflation, deflation.
Yeah, disinflation and deflation are very different. Yes.
Right. Disinflation is from June to where we are now. That is disinflation. That's where the rate of change no longer goes up. The rate of change starts to go down. That is disinflation. Deflation is when it goes below zero, when it's negative inflation. And that's when the actual cost of goods starts to become less and less than it was a year ago. So while it's a good thing, it's a good thing for the economy and a good thing for everybody that, disinflation is reducing the rate of change, mm-hmm. It still means that the cost of goods are high. So keep that in mind. Yeah.
So how's the setup for next week? Is a lot of people flat going into Wednesday? What's going on?
How's really good
early
question.
Setup?
Good question. I had a great week last week. In fact, even Friday morning, my account was up dramatically. And then when I looked at it at the end of the day, I'm like, oh my God, what happened?
Where'd it go?
Yeah, like half of my, not half, maybe 30% of my gains had disappeared.
Oh, okay.
So yeah, what happened? So let's take a look at, let me see which one. This one. So here's last week. And there's something that concerns me on this chart.
Uh-oh.
Let's see if you can pick it out.
Me?
Yeah.
Oh man. Let's see.
This is a pop quiz, Mike. It's like you're in class and
well, that candle's not the one you want to see.
That's one of them. It's part of it.
I forget what they call that.
It's a shooting star candle. That's a bearish reversal.
Yeah, that's not a good one. Also, you broke trend. I can see in the up. You're accelerating down. Whatever that's called.
So the thing that I look at, and this is the way that I use the RSI. I'm going to go into
something
in more detail next week. This is the relative strength indicator. It's relative strength for this particular symbol, which is the S&P. Mm-hmm. And it can be somewhat helpful to identify turning points, right. Oversold and overbought. Mm-hmm. But you have to always remember that if the market is trending, it can stay overbought for a very long time. Mm-hmm. So you can't automatically say, oh, it went above 70, so it's time for me to sell. Now, you would have sold here if you did that. But then the problem with selling or trying to pick the top is you don't know when to get back in. Mm. If you were just using the RSI, you'd say, well, I'm going to wait till it gets back down below 40 before I get back in. Well, it never did. Right. Went down and just went right back up again. So what I use the RSI for is divergences. That is much more reliable to understand what's coming. Divergence, and they don't happen very often. Divergence means the price sets a higher price. That's this green arrow going up. But at the same time, relative strength sets a lower high.
So is that maybe a sign that retail is piling in late and the big boys are getting out?
Uh, yes, you could look at it that way, but some of the big boys could still be getting in here. But really, what it means is the rally is running out of steam. That's the way to read divergences.
Rally is running out of steam.
The rally is running out of steam.
Okay.
It's just getting tired. So the rally is
given that run, it's probably
right. It's had a great run since this sideways, since it broke out of the sideways thing here.
Yeah, the box.
The Darvis box.
The Darvis box.
Yep. Had a great run up, and what this tells me, and I look for these all the time. In fact, those charts that I showed you from I'll show the website at the end before we stop, but the charts that I showed on my website, I will actually put in a few annotations that show support, resistance, and if I see a divergence like this, I will put that in there too.
You will call it out because they don't happen that often.
They don't happen that often, but they are very reliable. So between this bearish divergence and this shooting star candle, which means that rally basically completely reversed on Friday. I've circled here where I think the market's probably headed. That's the next support level between 4,300 and 4,325.
Okay.
Now the 21-day moving average, as I've always said, is reversion to the mean. So it could come down. And here's the interesting thing about next week. The CPI number isn't until Wednesday. Right. So we could get 2 days of furious selling, Monday and Tuesday. And then we get a better than expected CPI report and the market takes off again. So
maybe
it's going to be a interesting and difficult.
So what I guess I hear you saying is when, your spidey senses are telling you is Monday and Tuesday don't have great setups.
Right. That's right.
But then Wednesday, we could have an outside force change the spirits.
Yes.
Okay.
CPI, and then all those people that are convinced that the Fed's going to be raising, well, all of a sudden on CNBC saying, well, they might actually not raise this next one. They might wait. We've had a low employment number, and we've had better than expected CPI, and maybe the Fed won't raise.
Yeah, maybe they won't. Maybe they'll take off.
Maybe they'll join us. Maybe they'll join us on the island.
Yeah. Well, right now there's plenty of space on the island.
Right. Exactly. So anyway, that's the way I'm seeing it. So I showed the CPI. What I didn't show is the commodities. So this will play an important role, or somewhat of a role, in the Fed decision on the 26th. And what you can see is, even though the CPI is going to come down dramatically, the good news is that the commodities haven't really been going up that much.
Yeah, they're just sideways.
They've just been going sideways, basically. Gasoline is the one that everybody looks at because they fill up their tank every week, basically, and they know what the prices are. But all of these commodities are basically just moving sideways. And you can see the previous rate hikes. You can see the first 5, the market continued down, but the last 6 or last 5, because the last one was 0, the last 5, the market continued to go up, even with all of these rate hikes. So the market is used to the rate, not only used to the rate hikes, but the market is pricing in the expectation that hikes will be ending soon.
Yeah, I think right now I think there's a couple of things that happened last week. One, the smart money is pricing in 95% chance of a July rate hike. Also, I think interestingly is I don't think there's anybody calling for rate cuts this year, at least nobody of consequence. So I think they've finally given that up. And you see the 10-year take off. The other thing I think we need to watch is the 2-year note. The last time the 2-year note got to 5%, which I think it did Thursday, it took out Silicon Valley Bank. We have a lot of banks who may be insolvent on their balance sheet. And we got to watch this. This is what took out SVB in whatever it was, March, I think.
Right. Here's the This is the 10-year and 2-year. There's the inverted yield curve.
Mhm.
I don't have the 2-year by itself, but I have the 2-year versus the 3-month right down here.
Yeah.
But here's the 10-year right here by itself. You can see how it's spiking up to 4.
Yeah, broke 4. Yeah.
Just a little above 4.
Mm-hmm.
But it has been moving up ever since really the beginning of well, it was moving up before the beginning of this year. It's right about at the high that it was back here. So it's about to actually break out to a new high.
Yeah. Yeah, mortgage rates are up. Mortgage rates touched 7.22 last week, I think on Thursday, before coming down slightly on Friday. It'll be very interesting to see how mortgage rates react early early in the week. So it's going to be an interesting week for sure.
Yes, it will. But so this, the good thing is that it's still below 0.
Mm-hmm.
So this is my number 1 recession indicator. When this goes back above 0, we've got 6 to 9 months before a recession. So it's a very reliable indicator of a recession. Everybody has said that. What they typically don't follow up with is that the recession doesn't happen until it goes back above 0. So you can see the last one here took 5 months, went above 0, took 5 months for a recession. Back over here, went back above 0, took 6 months before the recession. So it's not until this goes back above 0 that we start the clock.
Okay. I like it. All right. Well, you want to show your website? Just kind of round this up.
Yep. So for those that have been watching, I will no longer be sending out an email. Next week will probably be the last email that I send. And the email will have nothing more than the PDF of the weekly newsletter and a link to my website. So this is my new website here. And this will have, you'll have to register with your email, but I don't ask for a credit card and it's still free, and I don't sell emails or give them away or anything like that. So you can still get the newsletter, but you'll do it through the website instead. And there are a ton more things in the website, which I'll talk about next week on our session on the 16th. But this is the way, from now on, this is the way that I will deliver the newsletter, through this link. You actually go there now if you want to and sign up. Mm-hmm. So you don't need to send me an email. You certainly can if you'd like, but I'll end up just sending you this link. Yeah. Or you can just go to the link and register your email there. Yeah,
go to the website, breakpointtrading.net. Register. It is free. You do have to just put in your email address. This newsletter has been helping out hundreds of people, will eventually be thousands of people. He has been very right for a very long time. And I can't wait to do this next week with you. We're going to do a 3-hour session, really helping the one rental at a time community become better stock investors. And I appreciate you doing that. Thank you.
Yeah, it'll be fun. By the way, for those, I just want to say this real quick, for those that use their mobile phones, it's not optimized for mobile yet. So this is what you'll see when you use your mobile phone. Just click on this little menu bar down here, and you'll get all of the menu for all the pages. And the weekly newsletter is the number 1 right at the top.
There you go.
Just click on that, and it will ask you to register your email, and then it will download the PDF, and you can read it right from there.
There you go. 1 week away. I can't wait. We're going to make better investors out there. It's going to be a lot of fun. Dan, thank you so much, and enjoy your week.
You bet. Have a good weekend.
You too.